Hey, good afternoon, everybody, and welcome to Develop Your Edge. My name is Michael Burke with NinjaTrader, and it's Thursday, May 4th. I'm standing in for Tom Schneider, who is standing in this week for Jim Cagnina, who is in Kentucky for the Derby, taking some well-deserved time off. So, welcome, Anthony. Good morning. How's it going?
It's going great. We've got quite the busy day today. I know we're going to talk about my journey from 1996 to 2023. What's the difference between when I started then and where we are now? And I think what I'm going to try and get everyone to understand is that it's about adapting to the constant changing conditions. And as we have the market that we have today, I will go to the charts and I'll take a look at gold and I'll take a look at S&P and show really how I think we're in really a different situation than we were in the beginning of the year. So I'm looking forward to it.
Yes, that's outstanding. The technology has really evolved over the last 25 or 30 years. It's hard to believe it's 25 or 30 years, isn't it? Since we got started in this, that time has flown by.
I know, it's crazy. I mean, in 1996 is when I first went onto the trading floor. And at the time, I don't even really think I knew more than a handful of people that even looked at charts, if you think about that. And now that's all we look at.
Yeah, I mean, if you just go a few years before this electronic trading thing started, the only way to have charts was to either have someone draw them for you or draw them yourself, if you can imagine that. So it's incredible.
Yeah, I mean, there was a lot of guys in the pit. I know I will talk about that a little bit as well. And in those days, market profile, a lot of guys were drawing market profile and they were doing point and figure, because it was easy for them to do, whether it was the letters for like the TPOs and also the X's and the O's for point and figure.
Yeah, point and figure was one of the things that I looked at in those early days. That's amazing. Okay, before we get started, please keep in mind that the following presentation is for educational purposes only. All of the symbols and ideas discussed are for educational purposes and are not recommendations. Real-time trades are not going to be placed in this presentation, but if they were, those would be on a simulated Ninja platform. Futures trading is not suitable for everyone. If you're going to trade futures, you should be trading with risk capital. Risk capital is money that you can afford to lose that will not affect your lifestyle or your retirement horizon. Futures trading carries a high degree of risk, and you could lose more money than your initial margin. Okay, so Anthony, I'm going to turn it over to you. The topic today is really the evolution of that electronic trading era. So take it away.
Yeah, and I actually have a little graphic for everybody just to take a look at, and you'll be able to download this on my site where the Develop Your Edge show is. And the reason why I wanted to do this is because I get this question a lot. Number one, people talk about back in the good old days, like it was easier. Number one, it wasn't easier. It was very different, but it was not easier. Because once again, what we know now, I wish I knew what I know now back then, right? But at that time, you're always dealing with real-time data. And so you don't realize actually the scenarios that are going on and happening around you. And so a lot of people also ask me, what was it like back then versus now? What were you able to take with you? And what have you been able to do to, adapt to these changing conditions? And when I go back to 1996, when I first started, the very first thing that comes to mind was trading was dominated, obviously, by human traders. I just spoke with Mike a second ago and talked about at the time, really when I first came to the floor, there was maybe a handful of people that I knew personally that were using charts. And because at that time, everybody was just looking at what was the flow coming in and out of the open outcry, which was the pit. And so we used to laugh about this and say we were the center of the universe, right? And so all of the order flow came in there. So the charting, as much as maybe it mattered to some people, even back then, a lot of the guys off the floor that were calling orders in were looking at charts. But for the actual traders inside the pit, it was just by looking at the flow coming in and out, in which today, a lot of people are looking at order flow as well, right? They're looking at what is the reaction to price levels. And that is something that even from way back then to right now is something no different than an independent trader looks at. We just look at it differently. Back then, a lot of it was our ears and how loud was it at a price. And nowadays, it's like your board will light up with an order flow tool, which I talk about a lot here on NinjaTrader, and you'll see like what is the volume doing at these prices. And that is really, I would say, the primary thing that we looked at back then that was superseded everything. And it's a big reason why I think that to this day, I've carried it with me, because it's not about the price that you have. It's about the reaction to the price that the market gives you. And so you look at a day like today where we're flying through prices. If you have a level of support, the market is really just chewing up right through it. And so your level doesn't really matter to the market today, potentially. And it doesn't matter until the actual volume represents it. And so when you go back to the old days versus now, it's the same thought process. Everything that we did was taking the real-time data, digested it, and we would react off of what that data was. And which nowadays, like I said, the only difference is instead of human to human and hearing guys yelling at each other, now we're looking at the competition on the screen, and the computers and the algos and the independent traders and the institutional traders are all at once competing for these prices. And so to me, comparison, different in terms of how we gauged it, but same in how we executed it. Let's go. I was going to say, Mike, I want to bring you in and talk about that.
So it's interesting that you say that, because, when I first started, one of the skills that a lot of the traders that I worked with in those days were tape readers, right? There was this kind of skill around tape reading and being able to trade by just looking at that ticker or the trade, which is time and sales. And I thought that was very interesting. I never could master that, but I thought that was an interesting way of looking at the market, just looking at pure order flow and determining where the market was going next. And the other thing that you brought up there that I thought that it reminded me of is that in the late 90s, early 20s, a lot of floor traders were coming off the floor and they were trading at home on their own. And one of the things they missed was that noise. Noise of the noise going up and the noise going down in the pit. And there were actually services on the internet where you could actually listen to the pit and while you were trading at home. I thought that was interesting.
Yeah, the squawks. And it's because the traders back then, the number one way to determine whether or not a level mattered was sound. Because an order that just came in that got no response. And so therefore, why would I step in front of that, or why would I hit that, right? And think about this, everybody. When you look at a pit trader back then versus an independent trader now, if I go to buy, let's just say today, I don't know where the S&P is even trading at this exact moment. I know we've been keep going down. So let's just say I want to buy 70 evens, right? 40, 70 evens. That's 70.00. That's what an even is. And a broker were to come in and be like, even bid. If all of the locals and another broker comes in and goes 20 bid, half bid, right in front of that level, that would tell us that, number one, they're trying to buy as well. And so if they see a broker coming in, immediate reaction is, I got to bid with them or I got to bid in front of them. And so when you think about things, when you were to get to a support or resistance level and you're like, man, and I know some of us, we know how hard it is, but sometimes we'll be right on the tick and you'd be like, I can't believe I didn't get it. Well, that tells me in those instances that the market really respected that area. And that's no different than a broker going even bid. And then all of a sudden I didn't get them, or the broker didn't get them, and another broker goes 20 bid, half bid. And they do that because they want that area. So that area matters. And that's when I'll pay up for a price, because now I'm like, I may not get that. And right now, people might have that FOMO to chase it higher because other people may have that level. So psychologically, it's important to think about that. The next thing I want to bring up is the changing dynamics of support and resistance. So support and resistance levels, and this is the one thing that has really, that I've had to adjust to massively, is support and resistance levels used to be much less volatile. Like really, there was a time where I would come into the pit and I would know that if we made anywhere between an $8 and $10 range in the S&P, that was probably the high or low of the day. We just didn't make a range really much often outside of that, very rarely. And so if you just looked at that in its own right, you could just literally just look at that area and go, oh, we made a 10-point range. It's probably good for a $1 or $2 move. And it's because prices back then were lower. And also because of that, you had the percentage moves, which in terms of price distance were much smaller. So a 1% move then compared to a 1% move now is much different. And a lot of us traded very big for very small increments. And as time's gone by, that's just become harder and harder for us because now support and resistance levels aren't actually a level. Because of the volatility, they're actually a range. And this is one of the biggest things that has changed. And I think it's important to recognize as modern day traders is that you can't look at one single level with any sort of massive amount of conviction. You have to look at that level as a range of execution. The volatility around that level is so much greater now versus then because the prices have moved up. Modern day, we are almost trading in the S&P like we traded in the NASDAQ 10, 15 years ago because of the price difference. And so the higher we get, the more volatile we get. And you have algorithms and all these other things that are detecting, responses to the market and looking at these levels. Everybody almost has the same levels in the S&P. It's actually quite common. But that's why execution becomes such a huge part of it, is because you have to recognize that you have to adjust your position sizes around these levels and look at them more as ranges than it is actual just hard concrete levels.
Yeah, I agree. One of the things that you touched on that really comes home to me, and that is that a lot of times what traders will do is they'll want an exact price. They're not, if it doesn't hit that price, then they don't want to get in. And a lot of times what you really want is that if you've got the setup, you've got the market environment, you just want to get in. You don't want to wait for a particular price, and you don't want to worry about that. As long as it's within that range that you're talking about, you should just get into the market and not try to be too fine in that entry.
Exactly. And one tip that I have for everybody is psychologically look at it this way. If you are looking to buy a market that's in an uptrend and you get a mean reversion back to get in, psychologically, I'm always looking to buy at and above prices to get long in a trending up market. And in a trending down market, I'm always looking to get short at and below prices. And the opposite goes for when I'm trying to buy. Like today, I think is a trend down day. So if I'm trying to buy the S&P in a trend down day, and I'll show that maybe later when we go to the charts, I'm willing to buy at that price or below it because I want to buy closer to my stop because the momentum is now down. And so when I look at my range of execution, it's determined based on the environment of the day. And that's extremely important to me because, once again, it's not a consistent level I'm looking for. It's a consistent range. Next thing I want to bring up is the evolution of indicators. Boy, do we know how many indicators are out there. I go through the NinjaTrader platform and there's many on there. And I try to narrow it down to really a handful that I use. And one of the biggest things that we used to do back then versus now, that I think more traders are doing now than versus back then, is that everybody is on super short-term indicators right now. Everybody is trying to catch the turn real quick. Everybody is trying to look for these signals that happen right away in real time and be able to jump on the market for quick price action. When back then, we were actually a lot more patient, even though we were more short-term. And I think that psychology has shifted because of the access to so many indicators, and that people are just, I think nowadays, in much more of a hurry to make money. Everybody is thinking so short term. Even the swing traders like myself, which is more of what I do, swing to intraday, I am even still finding myself in a lot more hurry to looking for, these certain types of quick reversals or things like that to make those quicker bucks. But when back then is we really looked at almost everything on a little bit more of a wider time frame, and that actually helped us with the short-term execution because we didn't need to find perfect pivots or areas where we tried to buy lows or sell highs. We waited for things to turn. And once we recognized that that market had turned and we noticed it on the bigger picture, then we were more aggressive in that direction. And I think that's one thing that a lot of traders nowadays can take from these older school methodologies, is that even though we were shorter term, the thinking was nobody in the pit needed to see an RSI get overbought or oversold. That RSI might have been overbought or oversold on that indicator on that chart for 10 minutes before a trader was like, okay, now maybe it's time to step in, because at that time we didn't need that information. We still were waiting for reactions to price. And I think nowadays everybody is so quick to jump on an indicator reaction versus waiting for what we've talked about here is reaction to price.
Yeah, I think that because of the volatility that we have today, it actually works against the trader to be looking at 1 minute, 3 minute, 5 minute charts, because there is so much volatility there. And you place an order and the market moves significantly against you, you panic, you get out. Whereas if you're looking at a little bit longer term charts, you eliminate some of that noise and probably have a better chance of capturing some of that move that you're looking for.
No, absolutely, Mike. And the next thing I want to talk about is elimination of counterparty risk. In the past, traders, we used to have to deal with the human that was on the other side of the trade. And now today, trades are automatically matched. I do all my trading mostly through CME Group for everything. And back then, we had to worry about who we were trading with, what was happening. Did we bust a trade? Do we have an out trade? And that is no longer the case. I mean, I think that, I bring this up just to understand really the difference in time. Nowadays, we have this access. We have brokers like NinjaTrader going through and clearing through the exchange at CME, and we don't have to worry about that. We go in, and that is when we buy or sell, that trade is in. Back then, we didn't have that. And I bring this up just to understand how different in the times are, and like the things that we had to worry about versus the things that we don't have to worry about now. But it also makes me tell people that, look, it's also a thing to understand, just to slow things down a little bit as well, is to know that, look, you don't need to always constantly be in the market. And the reason why I kind of relate that to this is because back then we were actually more, I would say, particular about when we would trade. Once again, is that local bidding it? Does he really want it? Is this area, let's wait and see a little bit what happens. We saw one broker buy, and we were kind of more cautious about what we did. And so we always had a stronger hand in the market versus nowadays, everybody's just clicking the buttons. And I think that, you don't have to worry about who you're trading with. And I think that actually opens the door to just a lot of over trading bad habits versus back then, I would be like, listen, that big locals trading, that broker's bidding, do I want to step in here? And so I think psychologically understand that always want to have a strong hand in the market. Don't have a weak hand in the market. Just because you have easy access and you don't have to worry about counterparty risk, also think about, wait for those reactions, because who knows? All of a sudden, some volume might come in and show you something one way or the other. And it's important to me to always be the last in on a move than the first in, because the first in is always going to take a majority of the heat, majority of the fluctuation in the market. And then when it finally goes, you're probably going to puke them. But if you're the last one in, you tend to hold them longer for a longer period of time. You tend to go for more of the ride.
Yeah, I mean, the two things that come to mind here is that, that trader mindset of having the discipline to wait and having the patience to get in when the market is really, in your favor, or at least in the favor of the way that you're trading. And like you said, many traders just want to get in the game, and they'll force a trade when they shouldn't. And so I definitely think that being able to have that patience is so key.
Yeah, it's so important because we had to be pickier about it. I know for myself, especially when I was in the pit, I was looking at some of these guys and I'm like, man, if they're bidding, do I really want to be selling here? Right? Or if they're selling, do I really want to be buying here? And nowadays, because we don't have to worry about that counterparty risk, we just go in and click. I think that for me, I always take a step back and I'm like, okay, let me evaluate this here for even if it's just a few seconds. You'd be surprised, everybody, how sometimes just by watching for a few seconds later, it might benefit you, not only on your entry, but just understanding of the situation of what's really happening. Next thing I want to talk about is the changing nature of order flow. Order flow today is right there on the screens. I've already touched base on this. And it's so important, I think. Everybody knows that if you follow me on Develop Your Edge, you know that one of the things that I'm doing the most of is showing order flow, anchored VWAPs. I'm showing about cumulative delta. And these things are extremely important because you're able to see the order flow, and you're not only able to see it in real time, you're able to see it as time has gone by, right? What is happening? And so one of the biggest things for me is back then I was basically had to remember, was he bidding at 70 evens like I talked about earlier? Was what was happening at this time? How many were really bought? And nowadays we have this ability to see this in real time. And I think this is such an important aspect of becoming a better executor and having a better edge and a stronger hand in the market, because with these order flow tools, you are able to come in and actually see and go back and see how markets reacted at prices. And there's nothing, that's all 100% truth, because what it's reporting to you is the actual data. And I think that's such an important thing. And I think it's one of the greatest things for me as a trader who back then followed order flow, and to nowadays be able to actually see the order flow live. I think it's of massive importance to have it up on your screen. And it's why I talk about it pretty much every week here on Develop Your Edge.
Yeah, I mean, one of the things that I try to talk about is using volume to confirm the move. And order flow really kind of shows you what's happened in the past throughout that day and what's happening right at this moment. Incredibly important for figuring out where you are right now in the market.
No, absolutely. And that brings me to the last thing I want to talk about today before I go to the charts, and they're going to talk about gold and S&P. I definitely want to see what they're doing, number one, and I want to talk about what I'm seeing potentially happening in them. But the last slide is FOMO still persists. And, it doesn't matter how far back you go in history and markets, FOMO is always there. I've seen it so many times over and over again. It's why you get these one-dimensional moves. It's why you get bubbles. It's why markets operate the way that they do. And rallies bring in buyers, breaks bring in sellers, right? And there's that FOMO of wanting to be in the market and wanting to do something, which is always going to be there. And I think as a trader, hopefully today, part of what I'm trying to explain to you is that because that still persists, slow things down. Because I think the biggest difference between the traders back then, one of the biggest differences, I think there's a few, but this is one of them, is that once again, we were only in a hurry when we needed to be in a hurry. We were never in a hurry because we wanted to be in a hurry. It was always forcing us to be in a hurry. So when you think of patience, patience comes down to waiting for your areas, waiting for levels, and then being forced to trades. One of the most popular tweets I ever had, and I put this out many years ago, is great traders don't force trades, they are forced to trade. And I got that from watching some of the best in the world, waiting and waiting and waiting, and then all of a sudden they're super aggressive. So patience will also feed into when you should be aggressive, because the market will be responding to you and giving you that information and that feedback. Don't follow into the FOMO. Don't follow the price action just because it's moving in one direction. A day like today is super easy to get caught up and feel like you should have made money or should have done something. But once again, the best times are going to come in your trading when they come to you and you were patient waiting for them, but then also aggressive in your actions when that finally, when the market finally told you to do so.
Yeah, one of the big issues with traders when it comes to FOMO is what happens after the trade, not actually getting before or during, but after you exit a trade and then the market makes a big move and you feel like you missed out on something when in fact there's another trade coming. You shouldn't worry about those things.
No, exactly. And actually, let's go to the charts today. Maybe before we get to the Ask DYE question. And I just want to go over a couple of things here. Each and every week, you guys have seen me talk about Bollinger Bands. I've talked about auto-anchored VWAPs. I have a 60-minute chart up of gold right now. Something to watch when a market is really starting to move the way that gold is I pull up these 20-period 3 standard deviations, Bollinger Bands in the 60-minute. I recently talked about this in a show. When you start to see markets really start to get ahead of, in these moves, where volatility really kicks in, these peaks become extremely important to me. And so when you have like a move like you saw the other day, I was actually watching how gold was moving at this previous peak. And I want to talk about this right here. So anytime I see a peak like that, a lot of people have been saying, oh, I see those peaks. You talked about them as potential support or resistance. But when that top Bollinger Band gets above that peak, that is telling you that we are really expanding in volatility. Okay. And so you don't look them as support or resistance at that point. On a day like today, when you have gold where possibly where I look at the way outsides, that's something where I would look at as a resistance area, because even with that spike almost was like something that even the Bollinger Bands didn't even have enough time to recognize as expansion of volatility out of a price. And so I like to watch gold here. This area becomes of extreme importance. You have an extreme situation here where it was probably a 5 standard deviation move, maybe even more. And then a 3 standard deviation Bollinger Band couldn't even catch up with the volatility that happened there. So I like to look at that as like, if we were to blow up in here, I look for this area as going to be potentially resistance. And if it starts to squeeze past that, you could have another 4 or 5 standard deviation type move. So it's something I just really think to keep an eye on. And then quickly, I'll go to the S&P for today. You know, the S&P right now, normally when you see, let's go back to actually this right here. Actually, I'll move that back later. Look at this move yesterday when we exploded to the downside in post-market. Bollinger Band did not get outside that move initially. So that was a reversion right back in. So you could see how in this particular scenario, the S&P got that bottom Bollinger Band peak and ripped back in, but now since has expanded beyond it and we're starting to close back in. The only way I see this move starting to stall in the S&P is if this Bollinger Band starts to come back up and we really start to see those Bollinger Bands come back in and condense. Until then, I think that this move, you have to really watch this bottom Bollinger Band on a day like today, because even though it looks like it's pointing up a little bit, you have to watch for it to continue to potentially get flat, almost like it is here, and potentially start to open up again. You're not seeing that closure of that mouth like you are in the past. And so we're seeing markets right now being pushed on the edges. And this is where you have to be very, very careful of fading moves. And this is why I like Bollinger Bands, because the Bollinger Bands are telling me you don't fade this move just yet.
So in looking at this chart and that previous chart, is there any significance in your mind to the fact that those peaks in Bollinger Bands, you have lower highs here and lower lows here in those peaks? Does that help you with direction, or
Absolutely.
is this strictly are you strictly looking at levels?
It helps me because it's telling me that. So for example, here in the S&P, I could have easily seen a scenario where we blip down here, came back up, and this peak would almost come right back in. Then that would have been a really solid low. But the fact of the matter is that the Bollinger kept going lower, even though the market was going higher, like a divergence essentially. Right? The Bollinger Band was saying, look, volatility is still expanding beyond this price here. Versus when you go to gold, look what happened in gold. Gold, it started to turn back in. And so now gold is actually facing what I think is resistance up in here, because gold Bollinger Band fully turned in, and that move might just be a significant high that potentially holds. We won't know, but I look at gold and say gold is probably going to be hard to buy into this rally here. I think if anything, you start to find resistance because it has closed off. Even though it made a higher high, price expanded further than what the Bollinger Band did. And so I like to look at this and say, this area has strong meaning for me for resistance.
Yeah, I mean, we're in uncharted territory here in gold. What if it could break above that level, though? There's not a lot of resistance above that.
No. And so I think you might have a fight here for a little bit, but if this Bollinger Band starts to push above that peak and above that high, oh boy.
Agreed.
Don't be short. So maybe we go to Ask DYE, Mike.
Okay, let's do that. All right, so hold on a second here. My screen, I'm sorry, Anthony, I'm going to let you read that. I'm having trouble seeing that on my screen. Can you see that clearly?
I can barely see it myself.
Hold on.
Let's see what it says. I can't read it.
Can you guys push that into the rundown for us real quick?
There it is. On indexes, which COT report is more relevant? Larry Williams says to watch commercials, but they can be both hedgers and speculators. I mean, I'm not someone who's an expert on COT data like Larry Williams, so I will go with what Larry Williams said. One thing I will say about COT data when you're looking at equity indexes versus commodities, in my personal opinion, COT data and indexes is not something that I really hold with high value. And the reason is because I actually said in today's show, we used to be the center of the universe with the S&P 500. There was one place for all of the volume. So you were able to see all the positions between SPY and these options nowadays. I don't think that you're getting a great gauge of what the COT data is reporting. And let's not also forget why futures were originally created. Futures were originally created actually as a hedging mechanism to hedge against a portfolio. So seeing a lot of shorts in indexes could mean that they're extra long in portfolios. I don't think that you're getting a true gauge of what the market is representing. It doesn't mean it can't be helpful. I just think that I have to take it with a grain of salt. And the last thing that I want to show for today, because I think it's extremely important, if we could show my screen again, is the CME FedWatch tool done by QuickStrike. I think this tool is extremely important to watch right now, everybody. You can go to cmegroup.com or just Google search the CME FedWatch tool. And you look at June right now, it's saying that rates are going to be unchanged. And I think this is something you have to really keep an eye on, because as you start to go out, you look in July, it's actually saying the odds are actually that you're going to have a 1/4 basis point cut already in July. That's actually what the market is predicting at this point. And that is something to keep an eye on, because we could really start to get volatile here in markets. Make sure you know what's going on with the CME FedWatch tool, what they're predicting for rates, because I think it's going to have, I know it's going to have an impact on markets.
Yeah, this is a little odd that they're predicting a cut right after
A hike.
the day after the raise.
Isn't it nuts? And so when you look at it, it's like, you want information on this, everybody, this is the place to go. And it's saying that we'll probably, if it's not then, that maybe it's September. September is a 46.5%. It's already saying only a 12% chance we stay where we are then. And when you get to November, it's saying that we're going to be 50 to 75 basis points lower. And when you get to December, it's saying that we're going to be 75 to potentially, almost 100 basis points lower by the end of the year. We just got done raising rates. So that tells you that the market thinks that there's something potentially going to happen to cause the Fed to not just pause, but to actually shift. So we'll see.
The repercussions of 3/4 of a cut between now and December, I can't even imagine.
No,
that's a topic for another show.
Yes, it is.
All right. So Anthony, we're almost out of time. Anything else you want to cover here before we
No,
go?
that's it, everybody. Hopefully I took you back a little bit through a journey of time with how things were and how things are now, and understand that we're always adapting. That's why we're here every week with Develop Your Edge. It's all about getting better. There's no market time that I've ever seen that's exactly replicated. They're all a little bit different, and there are different tools that we use. Look at how we're even using, GEX tools and Gamma right now, as 0 DTE options are the craze, and that might last for who knows how long. But it's one of those things where maybe we use them for a period of time. Maybe they last for a decade. We just don't know, and we have to constantly be working on our edge. And that's why I like sitting down with you guys every week on Develop Your Edge.
Well, we really enjoy you being here. Thanks again for an outstanding presentation. I think this was really valuable for traders really at all levels. Everybody, you can find Anthony Crudele on Twitter and Instagram. Where else can they find you, Anthony?
Just go to anthonycrudele.com, or you can go to placeyourtrades.com.
So coming up today, we have Blue Putnam from the CME. He's the chief economist there. That'll be a very interesting conversation with Tom Schneider, talking about what happened yesterday at the FOMC meeting. So don't miss that. And I'll finish out the day with bars closing at 3:15 Eastern time. Thanks again, Anthony. It was great seeing you. And everybody, have a great day in your trading.
See you, everybody.